Hey guys!
Hello.
We're outside, it's nice.
Super nice out today.
Actually, we were batching. We're recording more than one.
So if you notice it looks familiar, that's why.
We have a few outside in the same position.
Same outfits.
In the same outfit. We got some questions from you guys, and we're just going to answer them. Like batch answer questions.
Yeah, we'll just go through a couple and quickly go through them.
Yeah.
So first question, what if I am self-employed?
What does that mean? If
Yes.
someone wants a mortgage.
Yes.
So, self-employed people, generally, if it depends, it always depends. That's for anything. For mortgages,
There's always numerous variables in it.
So, if you're self-employed, first of all, it depends if you're sole proprietor, if you're like claiming everything on your personal income taxes, or if you're incorporated, it means different things.
Yeah.
If you pay yourself a salary, if you get dividends, like there's so many variables that it's very per case for that specific stuff. But generally, it's basically like if you're claiming on your personal income taxes, you want to make sure that you're like you don't bring it down too much, like because the bank's going to use your net income,
your personal net income.
Your personal net income. So if that's either with getting paid like from your company, or if you're just getting your like putting it all on your income taxes and then deducting your expenses, and then you have your gross income and your net. The bank uses your net income.
I know it's a little confusing because for salary employees we use gross income.
I know.
But for self-employed they use net income. Some lenders, depending like if you're sole proprietorship, for example, if you have a lot of expenses, they may allow you to gross up your income by 15%. But if you're writing your income off to nothing, well, that 15% really isn't going to add a whole lot to it. If you write it down to $25,000, it's not going to be the make it or break it in the file.
So it really depends on like who else is on the application too. What, like if you have a lot of car payments, like if you have business card,
if you've got a business card or your personal name that's reporting to your credit bureau, but maybe you pay for it out of the company and you're expensing it on your tax returns,
stuff like that,
still really, got to debt service it with your net income. And another thing I just wanted to say real quick is that like if you're self-employed, it needs to be a 2-year average as well. If you just started your business last year, can't use that income yet because sorry, really loud motorcycle. Self-employed income, it's not guaranteed, right? You have to find the business yourself. So the bank wants to ensure that it's going to be sustainable. And to determine the sustainability of it, they use a 2-year average.
So that was very important. Should have started with that. So the bank's going to use a 2-year average of your net income. So whatever that is. And also they want it to be, usually they like it to be the same type of income. So if you pay dividends 1 year and then salary next, or not, or like
they want it to be dividends each year, usually. Salary each year, business for self each year, you know what I mean? And also another thing is if your most recent year is lesser than your previous year, they're going to use a lesser amount instead of a 2-year average.
What else? I thought about something and then I forgot. So self-employed.
Depending on if you have negative retained earnings, if you're a corporation, that could affect the deal as well, because some lenders will require to see your T2 generals. Not all of them will, but some of them will, or they'll want your company financial statements. So
they ask a lot more documents. We usually need like a whole bunch. And you need to have your income taxes paid.
No outstanding income taxes.
So you can't, even if you're making payments on with CRA, like you made an arrangement, that's fine for
CRA.
But for mortgages, like you need to show that it's paid off.
The bank's not going to take the risk that you're going to respect the payment arrangement, because if you don't respect it, then the CRA can put a lien on your house, and if the CRA decides to force a sale, well, the CRA is going to force a sale.
So it's just too risky for them.
And the CRA will get paid before the bank gets paid too, so.
So generally, I mean, obviously check into it if you need to know. But the 2-year average is very important. So if you're thinking of buying a house and you want to start a business, then maybe try to make it so that either you wait 2 years or that you buy the house before you start your new business.
Keep your job.
If you don't have anything any other income, right? And also when someone starts a business, I think now, I think that program still exists, but they can get EI for a year. I've seen that.
I don't know.
I don't know if it's still there.
I think
but
you mean the CBDC program?
I think so, yeah.
Yeah, there's a program through CBDC, and it's like CBDC pays you, and it's kind of like EI exactly for the first year to help you set up your business.
Yeah.
That they won't use that income. No.
So basically, if you're doing that, it pushes out your...
You're now 3 years.
Yeah. If you don't have any income the first year.
Yeah. Yeah.
So that just kind of
answers that question.
About
on to the next one.
Yeah.
How long do you need to be working to get a mortgage?
That's a great question. So, I mean, it's...
depends on your industry.
It depends.
Yeah.
So, if you're full-time, as long as you're not on probation, generally they can use your full-time income. They're gonna look at everything, like how strong the whole deal is, like the whole application. So if you have your own down payment, that helps a lot. If you have a brand new job, if your credit's really good, then like usually that
helps a lot. Good, if you worked in the same industry previously, but just for a different company, that can also help out. Say for example, if you were a teacher in Ontario, now you're a teacher in New Brunswick. Probably teacher's not the best example to use because we need to use a 2-year average for teachers because you get EI in the summertime.
Maybe.
But
sometimes they don't. It
yeah,
depends.
that's true. Depends on their contract.
Yeah. But whatever it is, if it's full-time, then you're basically, even if you're not on probation, we can try. The banks, it's not as the application isn't as strong if it's a brand new 1 month at the job.
Yeah, exactly.
Like,
they're gonna want to see a little bit longer tenure there. I mean, like we can try. Sometimes it might go through if everything else is super super strong.
Right.
But if it's not like A1 everywhere else, then they're gonna say no, employment's too new, not enough fallback, things like that.
Depending on if there's like 1 person or 2 person on the application, that too. There's a lot of variables. But if it's the only one that's kind of like a negative, like
then you're probably okay.
Then probably okay.
Yeah.
If you have your own down payment, and like someone else is on the application with you. If someone just like got out of college or university and it's like their first job, outside of that, and they're the only person on the application, and like they have new credit, like all of that combined might be like the greatest. So they might ask for like a co-signer. So worst case is that we can only use your income once your probation period is done. But as long as you're full-time, so if you're casual or part-time or seasonal,
temporary contract employee,
then usually they need a 2-year average.
Unless your part-time hours are guaranteed. If you have a part-time job with guaranteed hours, then usually we can find a bank who will accept the minimum guarantee of hours. But it needs to be guaranteed. Like your employer has to be willing to state on a letter that it's guaranteed minimum 20 hours a week, 15 hours a week, whatever it is. Plus also confirm that over the phone. So if
also your pay stub.
Exactly.
So basically that's like for the income. That's how it generally works.
Yeah, exactly.
I mean, and this is like for everything we were saying here is mostly for A lenders. So like sometimes
alternative lenders, there's some gray areas.
Like, but it's just we're not gonna go there right now. That's very specific to whatever that situation is.
Yeah, exactly. If you've got questions about that, then reach out to us individually. Yeah.
Cool.
All right. So next question. Just gotta unlock my phone.
I think I remember the next one.
Does mat leave affect a mortgage application? And what about child benefit credits?
Okay.
Yes.
So, I mean, it does, and sometimes it doesn't.
Yeah.
So, if you're full time and you can get a letter stating that you're going to return with the return date,
and as a full time salary employee or hourly employee with guaranteed hours,
we can use your income still. If you're seasonal or part-time,
contract, commission based, anything that requires a 2-year average,
self-employed,
your maternity leave is definitely going to affect that because your 2-year average is not going to be what it otherwise would be, and we are not going to be able to use the EI income that you had generated on maternity leave as part of your 2-year average. Because you hadn't received EI the year before, it wasn't the same situation, so the bank will refuse to use that.
And it's going to affect for the next few years if we use the 2-year average. So if it was like 2 years ago and we need to use that income and the actual income, like if you're self-employed or contract or whatever, part-time, then it will affect it. So that's really annoying, but it is what it is.
We don't make the rules.
Hopefully someone else is on the application that can help. But anyways, it just affects it for that period of time.
Yeah.
I guess, so.
And child tax credits.
Yeah.
Can definitely use that. Will help out your application.
The CCB.
Yeah.
So yeah, we have actually quite a bit of lenders now that can use it. It didn't used to. We didn't used to have a lot of them.
A lot of them have opened up their doors to child tax.
To it, and that helps a lot. Some people have a lot.
Some people receive like $600 a month for child tax. It's quite a bit of money. You know what I mean? Over a year, that's like $5,000. So
yeah, so it can make that difference for sure. So
it can put you from not qualifying to qualifying.
Yeah, for sure. So that does really help. So as long as everything else is like strong on the application too, they don't like you to be maxed out.
And they don't want the majority of your income to be child tax credit either. They have a rule of how much child tax credit they can use compared to the employment income on the application or the other income on the application.
Right. They don't want that to be the sole like, income on the application.
Because at some point you're not going to get that anymore. So
right, and they can only use it till most of them it's like 12
until they turn like the year that they turn 13.
13. Okay.
Yeah. So if they have just turned 13. Or they just turned 12, then it's okay up until they turn 13. Once they're in the year that they're turning 14, no more.
It doesn't work. Yeah. We can't use that child
for the majority of lenders. I think there might be one that'll go up to 15, one or two.
But it's like most of it.
But don't bank on those ones because it's only one or two. Don't put yourself in a box or in a corner. Yeah. Can I change jobs while applying for a mortgage? No.
Don't do it. No, don't do it. I mean, obviously it might happen, but it's messy. No, because it's going to change everything.
Yeah, because if you change jobs, you're probably going to be on probation with your new employer. You might not be making the same amount of money. Are you going into the same industry? Are you getting a promotion?
Even if it's higher, it's like they're not going to...
Does a promotion give you probation? Like, I mean, unless they're just giving you a promotion, there's no probation and you're fine.
Yeah.
And there's nothing that's changed. Yeah, then you're okay.
Within the same company. Yeah. That's fine.
Yeah. As long as there's no probationary period.
Right.
But sometimes, like, some people, depending on the company that they work for, depending on what you were doing with them, when you get, like, a different position, they might put you on probation for that position.
Yeah, it happens
sometimes. It does. It's not very common, but it does happen sometimes.
So those are the questions you need to ask.
Yeah.
But whatever happens, you just need to ask us first before you make that decision. Because we can tell you exactly what that will mean for your application. Because if you're like not using your income for some reason,
then fine, go for it.
Whatever. But if we are, then no, we don't want you to change jobs if it's with a different company. So that's a good question.
All right. Do you factor cost of kids in mortgage application?
Don't.
No.
So I mean, okay, let's wait.
Big truck
going by. So no, we don't, which is why
you shouldn't max out.
You shouldn't go to your maximum pre-approval amount if we're using like both incomes and
your child tax benefit, and your child support. If we're using all of your possible income and we are at the limit, don't max out because
because then like all of your daycare expenses,
that's not factored into it.
No,
neither is your car insurance, neither is your home insurance.
There's so many more things that you need to factor in. That it's going to cost you all of this. Plus my mortgage and property taxes and fees, like all that stuff, right?
Yeah,
so
exactly.
It's like, and like daycare costs is so expensive.
It's an arm and a leg.
So much. So it's like that's where when someone starts off and they don't have kids, it's so important to like think about like, okay, well, if we do want kids, then maybe we shouldn't go to our max. Like it sounds
Can we afford it if we decide to grow our family? Because a lot of people when they buy a house, especially with a partner, they're doing it because they want to grow their lives together, you know what I mean? And for a lot of people that means grow a family. Not everybody's going to, but most people tend to want to have kids.
Right.
So
that's something
to keep in mind.
Yeah. When you're making those decisions.
Also, are you buying a house with enough bedrooms?
Right. Yeah, that too. So it's just something to think about. And so that if you don't go to your max, it's always better. Like
you're gonna be fine financially. You're gonna be better financially. You're gonna be more comfortable.
It's always
we always like to have spending money.
Worst. Yeah. You plan for the worst
and hope for the best. And expect somewhere in the middle.
Yeah. So that's a good question.
Do we have any other ones? I think that was it.
Okay, well, we have one more.
Yeah. This one?
First time home buyer incentive. Is it worth it?
When to use it.
And when to use it. Okay, so we'll touch that. So basically, there are a few programs. There's nothing like there's no free pass. It doesn't give you a free down payment or zero down. Like there's nothing like that doesn't exist anymore. Basically, first-time home buyers, there's the biggest one I see that's probably the most beneficial is the RSP one.
Yeah.
So if you have RSPs, you can use them if it's your first house or if you haven't owned a house
in like 4 years or lived in a matrimonial home in the last 4 years.
Your spouse. Yeah. So if you can use your RSPs tax-free. So that's basically the only time you can take out your RSPs
without being taxed like tomorrow.
On them, until
until you've reached the 15 years.
But then you're going to pay tax on it. Okay, sorry.
Well, you have 15 years to reimburse it, and if you don't reimburse it, then you'll pay tax on it in 15 years.
Right. So you can take them out. You have 15 years to put them back. And which, if it's like coming out from your employer or your pay
if you're making regular contributions
then
to
it's
it,
going to happen automatically. You're going to reimburse it without thinking about it.
Yeah.
But yeah, so that one's a big one. And also you can, if you want to strategize, if you don't have RSPs, but you have your own money saved up,
put them in an RSP.
Put it in your RSP and make sure it's there for 90 days. And then we can use that as your down payment. So instead of using your savings, you're going to put it in your RSPs, but you're going to get the tax benefits.
Yeah.
Of
because when you deposit money into your RSP,
RSPs,
it takes away from your taxable income. So if you deposit, say if you make $40,000 a year and you took 7 of that 40 and you put it into an RRSP, well, now your income on your line 150 NOA is going to show like 33,000 because 7,000 became non-taxable.
Yeah, so that gives you a big return.
Yeah.
So actually you would make money by doing it that way if you can be patient enough to like do that process instead of like starting to look for a house right away because you have that savings. So if you can plan for it that way, if you know you're going to buy in the next year or whatever, that's a good strategy for sure. So that's the biggest one. The other ones, there's like
there's the NB housing program. It's through social development. It is a I guess borrowed down payment to an extent. It's to help low and modest income first time home buyers. Maximum household income is $40,000, which takes away a lot of people if you've got more than one person, more than one adult in your household who's working full time.
Most people don't qualify for that one. Like,
and it's a really long process to get the down payment from them as well.
It's a lot of little things that
and you don't know when you put an offer in on a house if you're going to be accepted for that program. So they won't take your application for the program until you have an accepted offer on a property. And it makes things really stressful with financing and closing. You need a delayed closing date if you plan to use those funds. Otherwise, you're really going to need to have a backup.
Right. So that one, I've seen it happen and work out for a few people. And it was generally like someone that was buying a house from either relatives or the landlord if they were buying the house they were living in. So like the closing dates weren't a big deal.
Yeah, and financing wasn't a big deal.
Right. Or like stuff like that. A private sale where, I don't know. It's just like it needs to be very...
very planned out.
And it can be because anyways, it's just so generally most people it won't qualify for most because it's $40,000 household income. So if you're a couple, like $40,000 between the two. So not everyone will qualify for that one. And then there's the CMHC one.
The CMHC First Time Home Buyers Incentive is a shared equity loan. So what that means is, like, let's say if you buy a house for $100,000 today, and you get the First Time Home Buyers Incentive, you have to come up with your own 5%, but then they will match your 5%.
They match what you put down.
Exactly.
So that one is more so, I would say it was created more for like the bigger centers where people can't really afford
Toronto and Vancouver, Montreal.
The payments. Where it's like really high purchase prices.
And also where 5% can be like $25,000. You know what I mean? Like, is it worth it for $5,000 to have like a shared equity loan that you're going to have to pay back at whatever the new value of the house is going to be? Plus to have it registered as a second mortgage.
So it costs more at the lawyers to do that because they register it as a second mortgage.
So you're going to pay more legal fees at closing.
But also the thing about the profit, like if you need to repay that loan when you sell your house.
Or 25 years. Whichever comes first.
So basically paid off your mortgage. So the thing with that is that you don't know if you sell it for more. There's a clause in there that talks about like
It's shared equity. So if you bought your house for $100,000, you borrowed $5,000, and then in 5 years you sell it for $150,000. Well, now you're paying back $7,500. You're paying back 5% of the current value.
Right. So
and they may request for an appraisal to be done to confirm what the actual market value is, depending on when you pay it off, if you're selling it, or if it's at the end of your 25-year amortization, or what happens if you want to refinance at some point during the time. The program is still relatively new. We don't know what's going to happen with that. Most lenders don't want a second mortgage registered behind them. Yeah, they'll do it for the purchase, but are they going to want to keep it on your refinance? Probably not.
You'll have to pay it out. And I don't know what that means because I've never done it. So it's new. When anything new, you just don't. Sometimes you
don't know until you do the first one, or until you see somebody do the first one and talk about it.
Like, okay,
that's a clause. That's the catch to the program.
Right. So I mean, it's not that there's always a catch, but it's just like we don't know for sure. So.
With government programs, there's normally a catch.
There's something. We'll see. But yeah, we just don't do them a lot here. I just don't really believe in that program that much. That's my personal
I don't really
opinion.
find it to be like
it doesn't
give you enough value.
Yeah. So like for what, like $20 on your payment or $50 per month?
If that $20 or $50 is going to make or break you per month, then like you should be lowering your purchase price, not looking at getting a shared equity loan.
Yeah. That's what we think. And then is there something else? Did we miss one?
No, I think we answered them all.
No? Yeah, right. And then I mean, first-time home buyers, when you buy a house,
you do get a tax credit.
You get a tax credit. So the next year when you do your taxes for the year that you bought the house, it's like, I don't know, $700 or $800.
$750. You can claim up to $5,000, and they'll give you 15% back.
Okay.
Yeah. I just did mine.
Okay, cool. Yeah. Woohoo. But yeah, so you tell your accountant or whoever does your taxes, or you put it on your if you do it yourself.
If you're cheap like me and do it at home.
But yeah, and I mean, you can still do a borrowed down payment if everything works and that you can qualify for it.
Yeah.
So you can get a loan or line credit, but that's not a first-time home buyer incentive. That's just anyone.
Yeah, anybody can do that. You just need to have sufficient credit to do so, and you have to be able to debt service that in your monthly repayment. So again, most people, it doesn't work for them because they're maxing out when they try to purchase.
You need to add that debt per month into your application. It still needs to work. So usually, sometimes, most of the time, it might not work. So,
depends on what your personal situation is, and also like when you do a borrow down, like the banks don't really like it as much because I mean they don't want you to 100% finance this house. You know what I mean? They want to have some equity into it.
It's not as strong.
Yeah, exactly. So.
And then, I mean, we're talking about down payments, so let's just add there. You can also do a gifted down payment, but it's still not a first-time home buyer. It's just like
it's just anybody can do that.
So, like, an immediate family member can gift you the money.
Only immediate family members, your friend, your cousin, your brother's wife.
They can't.
Doesn't work.
Doesn't work.
Yeah. Has to be mom, dad, grandma, grandpa, brother, sister, or adult children.
Yeah, and we need to see the deposit in your account or anyways, sign the
gift letter and the deposit in your account.
So
and it needs to match the gift letter.
So that's covering down payment / first-time home buyers.
Yeah.
Okay.
Awesome.
I think we've had 22
20
minutes.
We did enough.
So we'll make other videos for next time.
Yeah.
All right, hopefully that was helpful.
Awesome.
So enjoy. Hopefully when you watch this, it's sunny.
Yeah, hopefully.
Pre-record.
Or you can enjoy the sun.
Yeah.
If it's sunny. Or you can enjoy our sun.
Yeah.
If it's not sunny.
Yeah, cool. Okay.
Awesome.
See you guys next week. Bye.
Bye.